My wife says often, you're dead inside, man. You're a perfect financial advisor because you are literally dead inside. Welcome to FinTips, everybody. I'm Dustin Tibbetts here, financial advisor with Jazz Wealth, and we also have Eric here as well, financial advisor. He's got the cup.
Yeah.
I got a cup too. There's nothing in my cup.
I've got coffee. Like I'm drinking my coffee this morning.
We are doing this a little bit differently here today. And so, you know, you had the idea to cover something that, you know, is a little bit different. Do things just a little bit odd. So this is new for us here. So let us know what you think about it. But we were going to talk about the worst decisions you can make. Right. And we kind of talked about it a little bit, and I'm like, let's look at it from an investment side and from a planning side. So we want to share a few things here with you today, and hopefully we'll keep this short and see what you think. What do you got, Eric?
Yeah. So I think the biggest thing is what we're talking about is the worst investment decision you can make overall.
And my pet peeve. Like I would say mine is my main pet peeve about people as well.
Yeah. And so the idea is so many people in this market, and especially in a volatile market, they start to freak out.
Yeah.
And
normal. I mean,
it's understandable, but that's where our job really comes into play, because our ultimate goal as advisors, I think, is just to pull out the emotion. We can't focus on emotion. We have to focus on what is actually best for the numbers.
My wife says often, you're dead inside, man. You're a perfect financial advisor because you are literally dead inside.
Jeez, that's kind of awful coming from your wife.
Well, you get used to it, you know, over time.
well, my past, I mean, I was a firefighter, so you know,
oh God, yeah.
you have to remove emotion in scenarios in high stress situations, which totally different world, but it really feeds right into what I do here in finance, because you have to step back and say, hey, you know, nothing matters of what the news says, anything else says. We have to look at what we should do and what's best. And that's, you know, what we want to talk about. So,
well, mine is truly a huge pet peeve. So I'm getting worked up about it. I'm gonna let you go first. From a planning perspective, you know, to talk about like when you see somebody on the right path and then all of a sudden the emotion gets in hand, what is the mistake that you don't like there?
Yep. So from a planning perspective, I think the biggest thing is just really your pet peeve. We've already talked about it just a bit, and that's just once the market is volatile and once the market has went down, I mean, talking like a bear market, 20% down, it's the worst time to try to now go and be more conservative. I think there's a lot of danger when it comes to that from an investment perspective and from a planning perspective. But from a planning perspective, what I'm looking at with this scenario is where exactly somebody is. You know, we look at their probability of success. How well are they going to do in retirement? Well, if you've already taken the hit, that means you have less money in your account. So now is not the time to try to readjust, because now you're going to miss out on any rebound long term. That's what we've got to look at. So looking here at an actual plan, I've got a plan built right here. And in this plan, you're looking at a 71% probability of success. They have an estimated $927,901 remaining at the end of the plan. Now, that's with their current allocation. Now, if we stepped up their allocation a bit, we went a little more aggressive, maybe we could get a little bit more out of it. But right this second, looking at where we're at, knowing we're in a bear market, I'm not mad about seeing these numbers. I think these are good numbers looking at the plan in general. But what were to happen if I were to go in here and let's say that we pulled back and we went more of a balanced plan? Because this is what I'm seeing a lot of people talking about. Hey, maybe I should go a little bit more conservative now. I've already lost so much. I don't want to lose it all.
No, don't do it.
That's what they say. I don't want to lose it all at this point. And I mean, if you lose it all, unfortunately, everybody's going to lose it all. That's the fact there.
Well, think about that for a second. It's how many times has the market lost everything? Now, there's a stock, certainly. You could be in a stock, a crypto coin, whatever you're doing. Yeah, you could lose it all.
Crypto, yeah.
But, yeah. But think of like, how many times has a mutual fund said, sorry, we tried, we lost everything. And if that were to happen, we all have different problems.
Oh, yeah.
We're not concerned anymore.
Well, the insurance companies fail. I mean, people that are
Yeah.
so set on, I want something in a fixed account. Your insurance company's folded. I mean, it doesn't matter what their rating is. At some point, everything's done if we lost everything.
So I don't buy that one. But anyway, sorry to interrupt.
Yeah, no, I totally agree. So looking at this plan right here, we're going to adjust this to balanced. If I adjust this to balanced, and then I go down here and I hit refresh, what's this going to do to the plan if we now pull back a bit from where we are? It's loading, so it's taking just a second. There we go. So now we went from a 71% probability of success to a 67%. We're getting into that, gray area of saying, hey, are you going to make it or not? Because long term, it's all going to depend. There's a lot of things that will change with somebody's life, and we'll steadily update the plan. But the lower the probability of success, the less I like to see in this scenario. And with this one,
By the way, do you know what the sort of the break even is in NestEgg? If you're using NestEgg, the break even is actually 68%, but I say 65%. You don't want to be in that 60% because we can find numerous reasons where we could stress the plan and go, oh, if this happens, you're out. It doesn't work.
Yeah.
But that's right where it's at. Anyways, sorry.
No, for sure. And a big thing too is the higher the probability of success, oftentimes that means that you have a lot of fixed income. Maybe a lot of your income's coming from Social Security, anything else, a pension. That's going to boost up that probability of success.
And if you have too high a probability, I'm sorry, this is for clients. I don't mean to interrupt. But if you have like a 90% probability of success or higher, I always go into the cash flows and I go, is it the RMDs kicking in that causes them to go into a surplus? It's incredible how that happens. But yeah, you going more conservative, you can see it right on there how that is not a good thing to do.
Well, and right here, the one thing I really wanted to hit home on is, you're looking at $927,000 on the regular plan of where they are. They jump back, pull back a little bit more conservative. Honestly, this plan is built with a bit of a moderate to moderate aggressive plan right this second. This isn't like an overly aggressive plan.
Yep.
I've actually tested this, and if I go more aggressive, they have an even higher probability of success. But with this one right here, if they pull back, their money goes from projected at the end of the plan from $927 to $597. I mean, you're talking, $300 and something $1,000 difference.
For an emotional mistake. I mean, that's when you look at those numbers like that, it's like, okay, now ask yourself, do I want to really fear the market here? After everything I've been through and how far I've come, do you? I mean, that's the impact of that mistake.
Yeah, and I can get really geeky with it. I could go in and stress test it and tell you, well, what if it continued to fall? Yeah. We do that kind of stuff with clients, but it's not something, I could sit here and spend, I could spend, way too long.
Oh, yeah. It happens to me. I end up looking at night like someone's plan and I'm like, now, come on. And then next thing you know, like the world revolved around me for an hour and I'm like, what?
Exactly.
Well,
so what are your thoughts with it?
I have a huge pet peeve, and this is from the investment side. This one kills me. So I actually want to show this as well because this is a different way of looking at it if you're seeing it, right? So I'm actually showing here our large cap fund, right? Because it's one of the more aggressive funds. And if if the market gets volatile, yes, this is going to be very volatile. So over the last year, it's only down about 13% compared to the market's over 20%. So we're happy with that, and that's because we just got lucky with some cash. But so let's say this is your account, and you're like, oh, I'm down, gosh, this sucks. I'm down 13%. I'm watching the news, and I'm like, oh, if the world's ending, there's nothing
every day
in the news. The Shinzo Abe just got shot. I'm like, it just comes out of nowhere. But anyways, so you go, there's nothing good ever happening ever again. Well, clients will ask us all the time, okay, I think we should go more conservative, right? And then we'll wait this out and then we'll get aggressive then. Mm-hmm. All right, we'll take a look at this. Let's say you go to our moderate fund. We manage our own funds here so that we can show the performance and everything quite easily. But so in purple here, here's a moderate fund. Oh, that's not so bad. It only fell 7%. It's supposed to fall 7%. It's a moderate fund. Like it's not supposed to be 1-for-1 with the market. So play this out. You go over here and you say, all right, I want out of the large cap fund. I want to be more conservative. Big mistake, man. That's a huge mistake because you're slowing down when things are moving faster. And when things move up, of course, the large cap fund is going to dwarf the moderate fund here. Let me just zoom out actually to show. Look what happened last time. So let's say the market falls. This is just right after COVID. You've got the large cap fund recovering. You said, "Oh my gosh, let me go be more conservative now." You got left in the dust, right? Look at the return difference. Not because we're magic. I'm not trying to say like, "Oh, look at our funds," but it's supposed to perform that way. So now you got left in the dust. You do that twice in your lifetime, now you're in trouble, right? Because you can't recover from a spread of almost 20%, more than 20% at times. You can't get that back if you're going to be that kind of emotional. So huge pet peeve. I mean, I get like worked up and sweaty and stuff when people are like, "Oh, I want to switch to cash." I'm like, just stop it. Like, yeah. I mean, there's times I've been like, you're going to have to leave here. Like, that. This is not my advice. If you won't take my advice, why are you paying us? So I get like that upset, but huge pet peeve, and I wanted to show that just so you could see it.
Yeah, I've seen the people where they sit there and they'll literally say, I want to get my money. I just want to make my money back, but I don't want to lose anymore. Well,
Yep.
If you want to make your money back long term, that's going to take a lot longer when you pull back. And it's like, well, when's the time to try to flip the switch?
Yeah.
And that's timing the market, which is
Sure.
not a good situation.
You can, and this never happens, but you can always say when the market's going higher, you can go, "I don't know. I don't like the looks of that." Okay, slow down then, right? We're not timing anything. We're saying, okay, I want to take less risk, right? It's no different than you go in your 401k and switching from aggressive to a target date fund or something. Great. You do that on the way up. You almost will never regret that, because missed opportunity is much better than on the way up than on the way down. Definitely.
100%.
Oh, man. Oh, fired up now. All right. Anything else you got for us?
No, I'm just trying to figure out how we're supposed to end this.
Well, we end it by asking people to subscribe and check us out at jazzwealth.com.
Hey, that's
and then
pretty smart.
Let us know, by the way. This is sort of impromptu, but this sort of focus, this different way where we're kind of chatting back and forth, we thought we'd try it on a Friday video. If it's a waste of time, we don't have to do it. You know what I mean?
I agree.
Could go play golf. Do you play golf?
I'm horrible at golf. I mean, I'll try to play golf, but sometimes I'm like a 9-hole guy.
There it is.
Yeah, because you play 18. That's just too long for me.
Like,
that's
let's do
half the
else.
day. It's like, yeah, I've got some stuff I need to get done.
All right. Well, thanks for joining us, everybody, and let us know in the comments below what you think.